How am I going to be investing in the next 3 to 5 years, and what metrics am I looking out to determine my investment decisions? Well, let's get into it. But please do subscribe actually, and leave a like of course, and actually comment, all 3 of them. Right, first of all we're going to start off with the 10 minus the 2-year yield. Now what I mean by this is the 10-year government bond yield and the 2-year government bond yield. Now what the yield is the interest rate on it. So if I went to purchase a 10-year government bond, they would give me a yield, which is the interest rate I would get back over the 10 years. So say if it's like 2.5 the yield is, then I'd get 2.5% each year for the 10 years. Yeah. And the 2-year yield, same thing. If I purchased a 2-year government bond, there'd be a yield on that, which is the interest rate, and that's the return I'd get each year. Okay, right. Now, when we say the 10-year minus 2-year yield, it's the 10-year interest rate minus the 2-year interest rate. And if it's negative, then of course we know that the interest rate on the 2-year yield is bigger than the 10-year yield. Okay, right, let's get into things. So on Wednesday the 2nd of Feb 2000, the 10 minus 2-year yield turned negative. So that meant the 2-year yield was more than the 10-year yield. Get it? So that turned negative. Wednesday the 27th of December 2000, it turned positive. So this, when it turns negative, this sparks some warning signs for investors, you know, troublesome times ahead. So we like to just make sure that we keep an eye on this chart. This is one of the best charts that I look at and when I'm making investment decisions. Fed interest rate. January 2001, they dropped their interest rate for the first time. It started the new cycle, if you want to say that. They're dropping the interest rate cycle. So the first drop was in January 2001, and they dropped it to 5.52%. Shortly, well, only a month after, we went positive on the 10 to 2-year yield. After this interest rate drop, we're going to take a look at the asset performance. Gold went up 10% over the next 18 months after this interest rate drop. S&P 500 dropped a massive 33% in just 18 months after this interest rate drop in January 2001. Now, let me take you over to the next recession, which was in 2008, as we all know. So this was the 2000 recession, and now let's analyse the 2008 recession. So again, the 10 minus 2-year yield went negative in Tuesday, the 27th of December 2005. It went to minus 0.01. It then turned positive Thursday, the 7th of June 2007, and it went to 0.08. Shortly after this, the Fed interest rate in August 2007 dropped to 5.75%. Once again, the first drop in the interest rate or economic cycle. As you all know, if you don't know the economic cycle, then watch my other video on it. It explains everything. Why interest rates go up and down. In this economic cycle part, it was the first drop of the economic cycle. So they dropped it in August 2007. Only 2 months after, the 10 minus 2-year yield turned positive. Asset performance over the next 18 months. After the Fed interest rate drop, gold went up a massive 42%. The S&P 500 dropped 48%. So gold increased 42% in just 18 months. And the S&P 500 dropped 48% in just 18 months. So what can we learn here, and how are we going to predict these future recessions? How are we going to predict future stock market crashes? 27th December 2001, the 10 to 2-year yield went positive, but we don't make any decisions then, okay? We don't make any new investments or sell anything or buy anything. We then wait for the Fed to come in and they lower their interest rate, okay? When they lower their interest rate within 6 months of the 10 to 2-year yield going positive, we know what decision to make. Boom, we get into gold, and the next 18 months we're holding gold, okay? The S&P 500 drops 33% in just 18 months in this 2000 recession. And then we can obviously sell our gold and buy the S&P 500 at its lows. And then obviously we just wait for the next economic cycle of the boom period, and it just goes up massively. Again, if we come over to the 2008 time, boom, 7th of June 2007, it turned positive, it's 0.08. We don't make any decisions now, okay? We're not making any investment decisions. We've just seen it turn positive. Okay, good news. Now let's wait. Fed interest rate, boom, drops to 5.75%. Okay, so again, it's within 6 months of the 10 to 2-year yield going positive. So then we can make our investment decision, which is to buy gold and hold it. The next 18 months, boom, gold went up 42% in the 2008 recession. S&P 500 dropped a massive 48% in just 18 months. So then at the end of 18 months, we can sell our gold and we can buy into the S&P 500 at a cheaper rate. You know, it's dropped 48% when we're buying into this. So much cheaper rate. So that is my investment strategy. Just watching the 10 to 2 year yield. Today, April the 1st, 2022, it did go negative. So just like the 2008, just like the 2000 look. Both went negative. Now I expect it to be at least a good through the 3 years plus before we see it turn positive and a Fed interest rate drop. Okay? So for now, I'm still bullish on stocks. I'm still bullish on S&P 500, and I'm still buying. Okay, I know I'm saving up for a recession. That's long term. Expecting a recession. Okay, I fully am expecting recession. 2024, 2025, around that time. Okay, we've got the warning signs. The 10-2 yields turn negative. Never has there been in the whole past, since the whole stock market's been established, since all this data has been collected. Never has there been a time where the 10 to 2 year yield has gone negative and a recession hasn't followed. Okay? So that's a stark warning there for all investors. So we saw it go negative today, this very day, Friday, the 1st of April 2022. Yes, today when you're watching it, it went negative. Or I'm expecting a recession to come within the next 2-3 years plus. So in my saving up for a recession guide, well, yes, I'm saving up for long term. Short term, I'm still bullish on S&P 500 on stocks. What I'm waiting for? Well, I'm waiting for the 10 to 2 yield to turn positive, and within 6 months of it turning positive, the Fed interest rate to drop. That's when I know, okay, boom, I step in, I put my investment decision to the test, and I get into gold, and I'm waiting for the next 18 months, and I'm hoping the S&P 500 does drop for a big buy-in. Because obviously we know when the economic boom comes back, the S&P 500 will be further up, and it will rise again, doesn't it? It comes back roaring, and yeah, when the boom period comes, it's done for. The S&P 500 is mega. It's just immense, the rises that it has. But obviously we want to catch it when it's fallen massively. So how are we going to predict that? Well, with these two metrics, hopefully we can predict the next recession. So yes, of course I could be wrong. I'm not saying I'm always right. I'm not saying that just because it's worked in the previous 2 recessions, it's going to work in the next recession. But of course, if we want to make investment decisions in the future, if we want to look for economic data that has an impact on the markets, I've spotted the 10 to 2 year yield and the Fed interest rate, and when these two combine within 6 months of each other, boom, these are the results. Gold up, S&P 500 down. In the recession before that, gold up, S&P 500 down. So I can just go by the data I've collected, and that's what I'm going to do for the future. So that is what's going to make up my investments in the future. So for now, as I said, I'm still bullish on stocks, bullish on the S&P 500, still consistently investing in both of them. So yes, interesting stuff. That's what I'm keeping an eye on. As I said today, the 10 to 2 yield did turn negative, and you might be asking some questions here actually. Well, what if the 10 to 2 yield turns positive, you know? Because it did. Between December 2005 and June 2007, it did turn positive. Well, if it turns positive, okay, great, it turns positive. But we wait for the Fed interest rate decision. And these two have to happen within 6 months of each other, okay? If the 10 to 2 yield turns positive and the Fed interest rate doesn't go down within the next 6 months, we don't change anything. That's what I'm predicting. That's what I think a recession is coming up. They're all my investment decisions. And with these two metrics, it's going to decide the whole future of my investing career. Hopefully it all pans out, but as I said, I'm no financial advisor. You know, I'm not saying this is guaranteed to make you any money. This has just worked in the 2 previous recessions, and this is the economic data that I collected on the 2 previous recessions to predict a recession in the future. Because as we know, we look into the past to see what happened, why the stocks crashed, what economic data came out to maybe mean that it crashed, and then we'll be looking for that same economic data in the future to happen to predict a recession and a stock market crash. And that's what I've done. So I hope you enjoyed. Hopefully you maybe agree or think that I'm onto something here. Put in the comments if you do or not. And yeah, I'd love to see your viewpoints, and I'll see you in the next one, people. See you later.